While you're watching this, something fundamental is happening. Something irreversible. $10 trillion are quietly, systematically leaving America, and almost no one is talking about it. Financial Times revealed the first signs. Bloomberg documented the early movement. But the real story, almost nobody is telling it. This isn't just another market correction. This is the moment Europe decided. Never again. January 2026. Denmark. A pension fund makes a decision. $100 million. Every single dollar in sagte treasury bonds sold, fully liquidated. The markets barely reacted. It looked insignificant, a drop in the ocean, but that's where everyone got it wrong. Because this wasn't just a sale, it was a signal, a starting gun, the beginning of what economists are now calling the Great Financial Separation. And Denmark wasn't alone. The Netherlands watched closely. Sweden started running the numbers. France followed. And suddenly, we weren't talking about 100 million anymore. We were talking about $10 trillion. 10 trillion? That's not just capital. That's a force powerful enough to destabilize economies, to freeze financial systems in seconds. And it's already moving, right now. Let's break down the math. Europe holds around $10 trillion in American stocks and bonds. To put that into perspective, that's roughly 7 times the entire GDP of Germany. But this money isn't sitting idle in vaults. It's active. It's circulating. It funds the U.S. deficit. It fuels venture capital in Silicon Valley. It keeps the dollar system running. But here's where things get interesting. Over the past 13 years, American ownership of European companies didn't just grow. It exploded. From $1 trillion to $79 trillion. The U.S. didn't just invest in Europe. It bought it. Piece by piece, company by company, and Europe watched. Until January 2026, Anu Schiel, investment director of a major Danish fund, said it plainly in an interview with the Financial Times. The U.S. fiscal deficit has crossed critical safety thresholds. Translated, the U.S. government can no longer guarantee the long-term stability of its own currency. This isn't ideology. It's risk management. Meanwhile, Scott Bessent tried to calm the situation. He downplayed the $100 million move as insignificant. But what he didn't mention is this. Danish pension funds alone hold around $780 million in U.S. assets, and Denmark is small, tiny. Scale that up. Germany, France, Italy, the Netherlands, every pension fund, every sovereign fund. If that avalanche starts moving, the dollar doesn't just weaken, it collapses. Not in theory. In reality, now consider this. The U.S. net international investment position sits at negative $27 trillion. Every single year, the system requires about $1 trillion in foreign capital just to function, just to stay alive. For decades, Europe provided that capital. Not anymore. Amundi, the largest asset manager in Europe, sent a clear message to its clients. Diversification is no longer optional. It's survival. Because sit equity valuations, completely detached from reality, inflated beyond fundamentals, a bubble on steroids. And Europe is holding the needle. March 2026. UniCredit puts 35 billion euros on the table. The target? Commerzbank. But this isn't just another acquisition. This is strategic consolidation, preparation. The goal? Build a European banking giant strong enough to compete with JP Morgan Chase, Goldman Sachs, and the entire Wall Street ecosystem. And others followed. Intesa Sanpaolo, BNP Paribas. This isn't expansion. This is reallocation. For years, European bank capital flowed into the U.S., into tech companies. Startups, the Silicon Valley dream. But the cost? Double compliance. Washington regulations plus Brussels regulations. Rising costs, shrinking margins, less control. So Europe made a decision. Stop. Now the capital flows back into European infrastructure, energy systems, decarbonization, local industries, local profits, local control. And the numbers don't lie. Interbank lending within Europe surged after these moves. Banks are moving away from the dollar and toward the euro. Why? Because inflation became unpredictable, because the Federal Reserve is losing control of its own policy cycle, because the dollar is starting to look like a ticking time bomb. And this is where the spiral begins. Political pressure escalates. Donald Trump threatens tariffs, 25% on multiple European countries. Even geopolitical tensions rise, including claims over Greenland. According to analysts like Jean Lemierre, this was the breaking point. But the real shock wasn't the threat. It was Europe's response. Systematic, methodical, around $40 billion in U.S. equity portfolios liquidated, not out of anger, out of legal necessity. Here's the issue. The EU enforces strict ESG regulations. Climate transparency is mandatory. But in USA, states like Texas, Florida, and West Virginia, ESG compliance is being actively penalized, even criminalized. European fund managers faced an impossible choice: violate EU law or violate U.S. law. So they exited, and now 60 to 70% of new capital flows are going into European decarbonization projects, not USA tech stocks, not Wall Street. At the same time, the Bloomberg Dollar Index dropped sharply during the crisis period. Demand didn't decline gradually, it fell suddenly. And now we reach the dangerous part. What are the options? Option 1. The U.S. raises interest rates aggressively to attract foreign capital back. The result? Economic collapse. Recession, massive unemployment, politically catastrophic. Option 2. The U.S. accepts the capital outflow. The result? A massive funding gap, around $1 trillion annually. The deficit explodes. The dollar crashes. Option 3. Political pressure, sanctions, threats, force Europe to stay. The result? Europe accelerates its exit strategy, builds new alliances, potentially even integrating Canada into its economic framework, closing resource loops without relying on the U.S. Every path leads to instability. There is no clean solution. And yet, almost nobody is asking the deeper question. What happens when hundreds of thousands of European companies change hands every single year? Because that's already happening. In Germany alone, over 600 businesses, many owned by the baby boomer generation, are expected to transition ownership. No heirs, no successors. For years, American investors stepped in, quietly acquiring these companies. Over 13 years, that's how ownership jumped from $1 trillion to $79 trillion. But now, Europe is saying, enough. New state-backed funds are being created. European investors are stepping in with one clear mission: buy these companies before Wall Street does. Secondary transactions are increasing. European-to-European deals. No New York, no IPOs, no Wall Street involvement. The cycle is closing. Europe for Europe. And this is just the beginning. And now, the second phase begins, because what we're witnessing isn't just capital moving, it's control shifting. In Germany, new data revealed something striking. Around 666,000 business owners are planning to exit their companies between 2026 and 2027. That's roughly 16% of all small and medium-sized enterprises in the country. 16%. Think about that for a second. If those companies hit the open market all at once, who buys them? For years, the answer was simple. Wall Street, American capital, would step in, acquire these businesses, often at discounted valuations, then redirect profits, intellectual property, and strategic decision-making back to the United States. Berlin and Brussels saw the pattern, and they understood the risk. Because this isn't just about ownership, it's about sovereignty. If Europe loses control of its companies, it loses control of innovation, of supply chains, of long-term strategy, so they moved fast. Local state-backed investment funds are now stepping in as partners for businesses without successors. Their role is simple: prevent foreign takeovers, and keep ownership within Europe. This isn't protectionism. This is self-preservation, because Europe learned the hard way. Once ownership leaves, control follows. And once control is gone, it rarely comes back. And so, the financial loop is being closed. European capital stays in Europe. European companies remain in European hands, and the dependency on external financial systems begins to fade. But the story doesn't stop there, because at the highest levels of asset management, the strategy is evolving even further. Vincent Mortier, one of the most influential voices in European finance, outlined a new approach for 2026. The barbell strategy. Not balance, not gradual diversification, extreme positioning. Capital is split between two distant poles. On one side, stability and local resilience. On the other, selective global exposure. But the core, strengthening Europe's independence from the dollar. At the same time, new alliances are forming. Mark Carney is actively working on deeper financial partnerships between Europe and Canada. The objective is clear: build alternative funding channels that bypass you. Sate, influence entirely. No veto power, no dependency. Even the European Investment Bank is changing its rules. Projects that were once off limits, defense, advanced technology, are now being approved and financed. The goal: end Washington's indirect financial control. And confirmation of this shift is coming from multiple directions. The Economist reports that European companies are systematically reducing their exposure to U.S. assets. Overconcentration is being dismantled. Why? Because a dominant market that becomes politically unpredictable turns into a liability. Sudden tariffs, currency weaponization, sanctions without warning. From a risk perspective, the solution is simple. Reduce exposure, step by step, methodically. Even central banks are adjusting. Swiss institutions are reporting significant capital flows back into the euro and the Swiss franc, away from the dollar. And in Washington, the pressure is building. At some point, the Federal Reserve may be forced to raise interest rates, not to manage inflation, but to retain foreign investors. But that comes at a cost. Higher rates choke economic growth. They slow investment. They increase unemployment. It's a trap, and it's closing. Because here's the brutal reality. The United States is running one of the largest negative net international investment positions in history. The system depends on continuous foreign inflows. Without that inflow, the structure weakens, and Europe has made its decision: reduce exposure, return to historically safe levels, prioritize internal stability over external dependence. Some countries are going even further. Finland, for example, has openly discussed integrating Canada more closely into European economic frameworks, closing resource loops and reducing reliance on the United States. This is no longer theoretical. It's happening in Berlin, in Paris, in Rome. European liquidity is no longer financing the U.S. deficit. It's no longer fueling Silicon Valley at the same scale. Instead, it's circulating within Europe, factories, energy systems, infrastructure. The money is staying home, and that leaves the United States facing an impossible choice. Either restore fiscal discipline, cut deficits, accept economic pain, and stabilize the system, or adapt to a multipolar financial world where the dollar no longer dominates, where it's not the first word, and not the final one. Because Europe is playing a long game. The objective is clear: build a financial shield, a system where the euro, combined with local capital, acts as a buffer against external shocks, especially those coming from across the Atlantic. This isn't a temporary shift. This is a structural transformation. The global financial system that has existed since the end of World War II is being reshaped. Right now, and for the first time in decades, Europe is no longer operating in the shadow of the United States. The financial vassal is gone. America is no longer seen as the ultimate safe haven. In many ways, it's now viewed as a source of risk: regulatory, political, and financial. The organized exit from U.S. assets didn't happen overnight. It started quietly. In Denmark, it scaled through institutions like Amundi, and it continues to expand. Because at its core, this isn't about short-term profits. It's about long-term protection. Protecting the savings of future generations. Protecting economic independence. Protecting control. Because the realization is simple and brutal. Political independence means very little if your financial system is controlled externally, if your capital is exposed, if your banking infrastructure can be used as leverage. And so, 2026 may be remembered as the year Europe built its financial fortress, where liquidity stayed inside the system, where profits stayed local, where control returned home. In the United States, it now faces reality, discipline or decline, reform or irrelevance, adapt, or watch the rise of a multipolar system where the dollar is just one currency among many. Europe has already made its move. The game is in motion. The euro is becoming more than just a currency. It's becoming a shield against volatility, against external pressure, against uncertainty. This isn't an emotional separation. It's a declaration of financial sovereignty, structured, calculated, and potentially irreversible. And that leaves one final question. What happens if the rest of the world follows Europe's lead? Let me know your thoughts in the comments below. If you found this breakdown valuable, make sure to subscribe so you don't miss what's coming next. See you in the next video.